So at long last, we find ourselves discussing a glimmer of potentially good news concerning the retail sector, a development that could ripple outward and offer some welcome relief for consumers as well. Today, the focus is on unpacking this evolving situation, examining the forces at play that are shaping the current economic landscape, and understanding what it might signify for our collective financial future. The core of this narrative stems from reports originating within the intricate networks of global shipping, the very arteries of international commerce. We are now hearing directly from cargo ship operators and prominent shipping companies about a noticeable and significant acceleration in the volume of inventory making its way across the oceans and arriving on the shores of the United States. This surge isn't a random occurrence. It's a strategic response to high-level political and economic discussions taking place between two of the world's most influential leaders. Specifically, the ongoing dialogue between President Trump of the United States and President Xi Jinping of China regarding tariffs is the primary catalyst. These discussions introduce a substantial degree of uncertainty into the market. The potential outcomes range from the striking of a comprehensive trade deal to the complete breakdown of negotiations, which would inevitably lead to significant shifts in trade policy, particularly concerning tariffs. This brings us squarely to the critical question: what tangible effects can we anticipate over the coming months as a result of these dynamics? That's precisely what we aim to dissect and understand in this exploration. There are fascinating and impactful developments unfolding not only from the corridors of power within the White House, but also within the broader framework of our domestic economy. Therefore, delving into the subject thoroughly is essential to grasp exactly what is transpiring and, more importantly, what the potential implications are for each of us as individuals navigating these economic currents moving forward. The immediate trigger for this observed increase in shipping activity is a strategic maneuver by numerous retailers. Faced with the potential for abrupt and substantial changes in import costs, these businesses are making a calculated decision to proactively fill their stores, their distribution centers, and their warehouses with as much inventory as logistical capacity and financial resources will allow. The driving force behind this urgency is a contingency plan for scenario where the tariff negotiations between President Trump and President Xi Jinping take a negative turn. Consider the potential impact if talks sour and the tariff rate on Chinese imports doesn't remain at the currently paused level of 30%, but instead reverts or escalates dramatically, perhaps even return to figures as high as 145%, as we have seen discussed or implemented in the past. Such a steep increase in the cost of goods at the point of entry would be absolutely devastating for retailers, making a vast array of products prohibitively expensive and undoubtedly translating into much higher prices for consumers, stifling demand and potentially leading to significant economic contraction. By bringing in large quantities of goods now, under the current tariff regime, which, while still elevated at 30%, is significantly lower than the potential worst-case scenario, retailers are attempting to hedge against this risk. They are essentially front-loading their inventory acquisition to secure stock at predictable, albeit still high, cost before potential tariff hike makes future imports dramatically more expensive or even economically unfeasible for certain product lines. Now, let's consider the immediate potential positive consequence of this surge in inventory. With a greater volume of goods arriving in the United States, an increase in supply, assuming demand remains relatively constant or doesn't increase at the same pace, the basic principles of economics suggest that prices for many of these items could soften or even decrease. More inventory means more competition among retailers to move product, and this competitive pressure can lead to promotions, discounts, and ultimately lower prices for the consumer. This influx of goods hitting the market represents the kernel of what could be construed as good news in the short term, offering a potential counterpoint to the inflationary pressures that have been a significant concern for some time. However, the economic narrative unfolding is not solely centered on trade tariffs and inventory flows. Another layer of significant uncertainty and potential change is emerging from the realm of monetary policy. Recent reports have surfaced, adding another dynamic element to the economic picture. Consider this development from Reuters, which highlights a potentially significant shift concerning the leadership of the nation's central bank. The report indicates that Scott Bessent is emerging as a possible candidate to succeed the current Federal Reserve Chairman, Jerome Powell. This information, attributed initially to Bloomberg News, points to movement on a front that has been a recurring theme. President Trump's previously expressed desire to see a change in leadership at the Federal Reserve, specifically to replace Chairman Powell. According to the report, citing individuals familiar with the matter, though notably, this was a report that the White House immediately denied. Bessent joins a select list of potential candidates for the Fed chair position. One name mentioned previously in this context was Kevin Warsh, a former Fed official whom Trump had reportedly interviewed for the Treasury Secretary role in the past. The fact remains, regardless of denials or specific names circulating, that President Trump has been conspicuously vocal about his views on the Federal Reserve policies under Chairman Powell, particularly concerning interest rates. A previous report, for instance, highlighted President Trump pressuring Chairman Powell to implement a substantial cut in interest rates, specifically a full percentage point reduction. Despite the backdrop of what was considered a strong jobs report at the time, this report was noted as being from early June. Why is this potential shift of the Federal Reserve and the associated pressure for lower interest rates such a significant factor in the broader economic discussion? It's a big deal because a decision to cut interest rates, especially by a substantial margin like a full point, has profound effects on the economy. While Federal Reserve Chairman Jerome Powell, operating under the mandate of the independent central bank, has maintained a cautious and data-driven approach, a different chairman, potentially one more aligned with presidential preferences, as might be the case if Scott Bessent were appointed, could be more inclined to pursue aggressive rate cuts. If Bessent or someone with a similar perspective were to step into the role of chairman of the Federal Reserve, the likelihood of interest rate cuts, potentially even deep cuts, would likely increase significantly.